What if you could save over 150,000 rands in tax this year just by changing one thing in how you pay yourself? Sounds crazy, right? But that's exactly what happened with one of our clients. A small business, not some giant corporation, just a normal service provider in Gauteng who had been doing things the way they thought was safe until SARS came knocking. In this video, I'm going to show you what exactly we changed, how we saved them over 150,000, and how you can check if your business is sitting on the same hidden trap. I'm Sia. I'm an accountant. I help businesses in South Africa to pay less taxes, stay tax compliant, and avoid unnecessary tax penalties. Let's dive in. Now, here's the part most business owners get wrong. They think saving tax means finding clever loopholes or hiring someone to cook the numbers at year end. But 90% of the tax savings we help our clients to unlock comes from mistakes in how they set up their business, especially how they pay themselves. And the sad part is that these mistakes look harmless until SARS sees them as red flags. So this client runs a professional service business, nothing fancy, around 10 million rands in annual turnover. When they first came to us, they were doing their own books and a part-time bookkeeper filing their tax returns. On the surface, everything looked clean. VAT was being submitted, annual returns were being done, no tax penalties. But the owner felt like they were paying way too much tax and they couldn't figure out why. That's when we offered to take a deeper look. So we pulled their financials and instantly something jumped out. The director was earning almost nothing in salary, like 6,000 rands a month or so, but withdrawing large dividends from their business every quarter. Now, a lot of business owners do this because they think dividends are tax-free, but they're not. And in this case, it was setting off three major problems with SARS. Number one, SARS could see a mismatch between turnover and declared salary. Number two, they were missing out on deducting legitimate directors' salary as an expense. Number three, no retirement contributions were being made, so no tax benefits there either. And if that wasn't enough, the dividends were being taxed at 20% after company tax had already been paid. That was double taxation, and it was a serious problem. So here's what we did. First, we restructured the director's compensation completely. Instead of a low salary and high dividends, we gave them a proper market-related salary that reflected the work they were doing. Not just for compliance, but so that the salary could be treated as a deduction for the business. Next, we set up pension fund contributions from the business side, another tax deduction. This meant a lower PAYE deduction overall, and the director was getting long-term benefits without an extra cost. We also adjusted the frequency and size of the dividends. By reducing them and spacing them properly, we lowered the dividend tax bill significantly. And the cherry on top, we cleaned up their EMP 201 and EMP 501 filings, because SARS does look closely when your salary looks too low to be real. And the result? When we ran the numbers over the year, the total savings was about 150,000 rands. That's what they would have paid extra had they stayed with the old setup. Now here's the bigger lesson. This client did not do anything wrong on purpose. They were trying to be lean. They thought taking small salaries and big dividends was clever. But SARS sees that as a mismatch. And if they dig deeper, they could reclassify those dividends as income, charge penalties, and even question your personal tax filings. So it's not about gaming the system. It's about understanding it better. When you pay yourself properly and structure your compensation with SARS in mind, not only do you save on tax, you also protect yourself from compliance headaches. So now the question is, are you doing the same thing this client was? If you're a director and you're taking dividends instead of a real salary, or you never looked at tax deductible pension contributions, or your EMP filings don't match your personal income, you could be overpaying SARS and putting yourself at risk without even knowing it. That's why we offer a free 15-minute strategy call where we review your setup, explain what's risky, and tell you where the leaks might be. The link is in the description. Don't wait until SARS sends you that scary letter. Hope this helped, and if you have any questions, drop them in the comments below. See you on the next one.